The United States is facing a serious economic challenge. The national debt is not just a number, it's a reflection of the country's financial health and stability. As the debt continues to rise, it casts a long shadow over the future of the American economy, affecting everything from government spending to individual livelihoods. Our national debt has soared past $33 trillion. This staggering figure is a testament to years of fiscal policies, economic decisions, and unforeseen crises that have collectively contributed to this monumental sum. This number represents the total amount of money the U.S. government owes to its creditors. These creditors range from domestic entities to international stakeholders, each holding a piece of America's financial obligations. This includes individuals, businesses, and even foreign governments. The intricate web of debt spans across various sectors and borders, making it a truly global issue. The debt has been steadily increasing for decades, but recent events have accelerated its growth. Economic downturns, stimulus packages, and unforeseen global events have all played a role in this rapid escalation. This situation poses a significant threat to the long-term health of the American economy. The ripple effects of such a massive debt burden can be felt across various sectors, from manufacturing to small businesses, each struggling to navigate the financial strain. The consequences of this massive debt are far-reaching. It impacts not only the present economic landscape but also the future prospects of growth and stability. The burden of debt can stifle innovation, reduce investment, and limit the government's ability to respond to new challenges. As the debt grows, so too does the cost of servicing it. Interest payments on the debt consume a significant portion of the federal budget, diverting resources from other critical areas. This refers to the interest payments that the government must make to its lenders. These payments are non-negotiable and must be met, regardless of the economic climate or other pressing needs. These payments divert funds from essential services like education, healthcare, and infrastructure. The opportunity cost of servicing the debt means less investment in the very foundations that support a thriving society. This further strains an already burdened system. Public services already stretched thin face additional pressure as resources are reallocated to meet debt obligations. The rising national debt also weakens the value of the U.S. dollar. A weaker dollar means that the purchasing power of American consumers is diminished, affecting everything from daily expenses to long-term savings. This makes it more expensive to import goods from other countries. As import costs rise, so do the prices of everyday items, from groceries to electronics, placing an additional burden on American families. This contributes to inflation, making it harder for American families to afford basic necessities. The cost of living increases, while wages often fail to keep pace, leading to a squeeze on household budgets. This complex issue requires urgent attention and a multi-pronged approach to mitigate its potential consequences. Policymakers, economists, and citizens must come together to devise strategies that address both the symptoms and root causes of the national debt. The longer we wait to address this problem, the more difficult and painful the solutions will become. Time is of the essence, and proactive measures are needed to prevent the situation from worsening. It's time for policymakers and citizens alike to confront this challenge head-on and chart a course toward a more sustainable fiscal future. By working together, we can ensure that the American dream remains within reach for future generations. The U.S. government has a spending problem. This issue has been persistent for decades, with each administration grappling with the challenge of balancing the budget. Despite numerous attempts at reform, the problem only seems to grow more severe with time. Year after year, it spends more money than it takes in through taxes and other revenue sources. This imbalance is not just a minor discrepancy, it represents a fundamental flaw in the way the government manages its finances. The revenue collected from taxes, tariffs, and other sources is simply not enough to cover the vast array of expenditures. This creates a budget deficit, which is the gap between revenue and spending. The deficit is a clear indicator that the government is living beyond its means. Each year, the deficit adds up, contributing to a growing financial burden that future generations will have to bear. To cover this gap, the government must borrow money. This borrowing is done through the issuance of treasury bonds and other financial instruments. Investors, both domestic and international, purchase these bonds, effectively lending money to the government with the promise of future repayment with interest. This borrowing adds to the national debt. The national debt is the total amount of money that the government owes to its creditors. As the government continues to borrow to cover its deficits, the national debt grows larger and larger, reaching levels that are increasingly difficult to manage. It becomes a vicious cycle. The more the government borrows, the more it has to pay in interest. This leads to even higher deficits, necessitating more borrowing. It's a cycle that is hard to break and poses significant risks to the nation's financial stability. Increased borrowing leads to higher interest payments. These interest payments are a mandatory part of the federal budget, meaning they must be paid before other expenditures can be considered. As interest payments grow, they consume a larger portion of the budget. These payments, in turn, consume a larger portion of the federal budget. This leaves less money available for other important areas such as education, healthcare, and infrastructure. The opportunity cost of these interest payments is significant, as it means fewer resources for programs that directly benefit the public. This leaves less money available for essential programs and services. Public services that many Americans rely on are often the first to face cuts when the budget is tight. This can lead to a decline in the quality of services and a reduction in the support available to those in need. This situation is further exacerbated by rising interest rates. When the Federal Reserve raises interest rates to control inflation, the cost of borrowing increases. This affects not only individuals and businesses but also the government. When interest rates rise, the cost of borrowing money increases. This means that the government must pay more in interest on its existing debt. Higher interest rates can also slow economic growth, making it harder for the government to increase revenue through taxes. This means that the government must pay even more in interest on its existing debt. The higher interest payments further strain the federal budget, making it even more challenging to allocate funds to other critical areas. This puts additional strain on the federal budget, making it even more difficult to get spending under control. The government faces a tough balancing act, trying to manage its debt while still providing essential services and investing in the future. Addressing the national debt requires a two-pronged approach. The government must find ways to reduce spending and increase revenue. This is easier said than done, as cutting spending can be politically unpopular, and increasing revenue often means raising taxes, which can also face resistance. The government must find ways to reduce spending and increase revenue. This will require tough choices and a commitment to fiscal responsibility. It may involve making difficult decisions about which programs to cut and how to reform the tax system to ensure a fair and efficient collection of revenue. This will require tough choices and a commitment to fiscal responsibility. Lawmakers will need to work together, putting aside partisan differences to develop a comprehensive plan that addresses the root causes of the deficit and sets the nation on a sustainable financial path. Failure to act decisively will have dire consequences for the U.S. economy and future generations. If the national debt continues to grow unchecked, it could lead to a financial crisis, undermining the nation's economic stability and leaving future generations with an insurmountable burden. The time to act is now, before the problem becomes too large to manage. The term schizo spike refers to the increasingly erratic fluctuations in the value of the U.S. dollar. This phenomenon has become a focal point for economists and financial analysts alike, as it represents a significant challenge in predicting market behavior. The term itself is derived from the word schizophrenic, highlighting the unpredictable and often contradictory nature of these fluctuations. This volatility is driven by several factors, including uncertainty about the U.S. economy, which has been exacerbated by recent economic policies and global events. The unpredictability of these factors makes it difficult for investors to make informed decisions, leading to a more volatile market. Geopolitical instability such as trade wars, international conflicts, and diplomatic tensions also plays a crucial role in influencing the value of the dollar. When global tensions rise, investors often seek safer assets, which can lead to sudden shifts in currency values. Think of the dollar's value like a seesaw. On one end, you have factors that increase confidence in the U.S. economy, and on the other, factors that decrease it. The balance between these forces determines the dollar's value at any given time. When confidence in the U.S. economy is high, demand for dollars rises. This can be due to positive economic indicators, such as low unemployment rates, strong GDP growth, or favorable trade balances. Investors flock to the dollar as a safe haven, driving up its value. This pushes the value of the dollar up. A strong dollar can be beneficial for consumers, as it makes imported goods cheaper and can help keep inflation in check. Conversely, when confidence is low, demand for dollars falls. This can happen due to negative economic news, such as rising unemployment, declining GDP, or political instability. Investors may seek alternative assets, causing the dollar's value to drop. This causes the value of the dollar to decline. A weaker dollar can have mixed effects. While it may boost exports by making U.S. goods cheaper abroad, it can also lead to higher prices for imported goods, contributing to inflation. The schizo spike is characterized by rapid and unpredictable swings in this seesaw. These swings can happen within days or even hours, making it extremely challenging for businesses and investors to navigate the financial landscape. One day, the dollar might surge in value, only to plummet the next. This kind of volatility can be particularly damaging for businesses that rely on stable currency values for planning and budgeting, This instability creates uncertainty for businesses and investors, making it difficult to plan for the future. Companies may hesitate to invest in new projects or expand operations, while investors might pull back from the market, leading to reduced economic growth. These fluctuations have significant implications for the global economy. Countries that trade heavily with the US may find it challenging to set prices and manage their own currencies, leading to a ripple effect of instability. A strong dollar can hurt US exporters by making their goods more expensive overseas. This can lead to a trade imbalance, where the US imports more than it exports, potentially harming domestic industries and leading to job losses. A weak dollar can lead to inflation, as imported goods become more expensive. This can erode purchasing power for consumers and create additional challenges for policymakers trying to manage the economy. The schizo spike is a symptom of a larger problem, the declining confidence in the US economy. Addressing this issue requires a multifaceted approach, including sound economic policies, stable political leadership, and effective communication with the public and international partners. The fluctuating dollar has a significant impact on global trade and inflation, affecting economies worldwide. When the dollar is strong, it becomes more expensive for other countries to buy US goods and services, impacting trade balances. This can hurt US exports and slow down economic growth, leading to potential job losses. On the other hand, a strong dollar makes it cheaper for Americans to buy goods from other countries, increasing consumer spending. This can lead to a surge in imports, which can be good for consumers in the short term, but has long-term effects. However, it can also harm domestic businesses that compete with these imports, leading to closures. Conversely, when the dollar is weak, US exports become more competitive, as they are more affordable for foreign buyers, boosting sales. This can boost US economic growth significantly. However, a weak dollar also makes imported goods more expensive for Americans, affecting their purchasing power. This contributes to inflation, as businesses pass on these higher costs to consumers, raising prices. The erratic fluctuations of the schizo spike exacerbate these effects, creating more instability. The unpredictable nature of these swings makes it difficult for businesses to plan and adjust their strategies. This uncertainty can stifle investment and economic growth, leading to a more cautious business environment.